sitting with, please bring those forth. Use the chat line as well. I think in a structured manner, we will also open the times for Q&As as we go along the session. For now, without much ado, let me then hand over the session to our lead facilitator, Larry Hobson. To those of you who are joining with us for the first time, I'm not aware of you, but we welcome you nonetheless. Thank you. Over
Thanks,
to you,
John.
Larry.
Thanks, John. I just want to check if you've got something on your screen, which is today's program. Is that,
yes, it is showing.
Very good. Very good. So we'll have 2 sessions going through the Quick Scan C presentation slides we've prepared, and then there'll be 2 sessions on the practical case study that we've done. And so Tatenda will be helping me with that part later. Tatenda is also with learning strategies. Some of you might have met him already. So we want to start off by asking a question. Have you used Quick Scan C? If you could just please raise your hands if you have. We'll get some election or referendum. This is a referendum, not an election. So it's if you could on your Teams screen, if you could just select the hand and raise your hands, we can see how many people have used Quick Scan C. So the first question is, have you used Quick Scan C? If you can just raise your hands. I don't see any hands being raised. Does that mean things are silent, or does it mean that nobody's used Quick Scan C?
Well, except one hand that I can see on my side, Larry. Yeah, it is pretty much
only one. Okay.
Yeah.
So that must mean then the second question in the referendum is, who has not used Quick Scan C? Who answers no to the question of well, yeah, who has not used Quick Scan C? Okay. So we've got, the numbers are growing. 18, 19, 20, oh, yeah, okay, keep on going. How many have we got in the session today? So we can just assume that everybody else hasn't used it. Okay, so we'll leave that at 22. Okay, so right, thank you very much for that. So yeah, if those who were here yesterday will recall that we went over the organizational information you've got to provide about your organization in Quick Scan B, and then the project technical information that we look at in Quick Scan B. So we're all familiar with that. So today is about the finances and the Quick Scan C. These tools were all developed long ago, in the early 2000s, and grown and developed well as the subsidy products have developed as well. So they've been, everybody who is an accredited social housing institution or other development agent is familiar, would already have been through the process, and there is a lot of work to do up front that's acknowledged, but it's all for a good purpose, to make sure that the chances of subsidies being well spent are increased. So fortunately, there haven't been too many cases of misspending of this type of subsidy, which is good, and it's from the regulation that's given by the SHRA. That helps in that process. So just to go through what we're going to cover today, the first few sessions will be about financial terminology, and this will either reinforce what people know about finance already, or will help those who don't have a good understanding of finance to get to grips with those terms. And then we'll be looking at the key performance indicators that are used, financial feasibility basics. Then there's a chart which shows, well, it's a diagram which shows the interrelationship between the KPIs. So that what happens if you change this variable here, which of the indicators is it going to affect? We'll spend some time going through that. And then we'll go on a quick scan 3C run through. And then finally, we'll close off with quick scan C case study. It's already been pre-populated with information, so we won't waste time with entering new information on screen. So there we are, we're ready to go. Right, the first part of the financial terminology. We use the term income for all money coming in. This is, it can also be called revenue. So it's a sum of all the earnings from various sources in a given period of time. Rental income is money generated in exchange for use and occupation of property. So collection of rents by a landlord from tenants, and usually on a monthly basis. Commercial rental income is money generated from commercial property use, such as shops. Certainly the inner city kind of developments would most likely have one floor with shops on the ground floor. So there's a bit of a mix of income there. Then we also get income from parking. So there'll be parking areas for use of the occupation of the tenants, but there's not normally one parking space for every accommodation unit. Normally find it's about 0.5 to 0.7 ratio between parking units and accommodation units for these social housing developments. Obviously, space is limited, so you can't be creating huge parking lots. Normally, as a revenue generator, when parking is added, because not people pay for their parking, but not always. Sometimes it's built in. Sometimes it's built into the rent. So the vacancy in property rental is a known hazard. Fortunately, in social housing, we normally have a waiting list for the property, so there's always somebody ready to come in if somebody leaves. So the turnaround period should be short. But when, if renting up, when you're occupying the building, if you don't have a full waiting list at the start, you can start with some vacant units. We put in an average vacancy into the quick scan C, I think of 7%, but we'll get to those norms later. Escalation, so the rental agreement would normally provide for rental escalation at CPI annually, and so that normally occurs once a year. We also recover operating costs in places where we don't have prepaid meters. So there's still some properties like that who haven't installed prepaid meters, and we recover electricity, water usage through the rental, the monthly rental statement that gets added to monthly rent. Next one on financial terminology, operating income. That's a measure of revenue less your operating costs. So if we look at the little table that's below, our gross rental is the top line. That will be if you've got 100 units times average 3,000 per unit. You'll be getting 300,000 rent received, less your vacancy. If it's 7%, that's 7% of the 3,000, less the direct operating costs, less overhead costs, and that will come out to our operating income. So we normally use the sort of norms that are being used are for operating costs and overheads together are between 1,300 and 1,600 normally. And so we should, at that stage, that operating income has to be enough to repay money that's been borrowed to fund those loan repayments. Anybody got any questions at this stage? Happy to go? Continue? Okay. Good. Right, so what are operating costs? Those are expenses associated with the maintenance administration of a business on a day-to-day basis. So for a property company, these will be things like utilities. Security is a big factor in social housing. Every social housing, the precinct is normally secured with security staff there. Office running costs, management salaries, those will be split between salaries that are related directly to the project or salaries of the head office staff. So let's go to the direct property operating costs, municipal property rates, maintenance and cleaning, long-term maintenance, insurance, security, other property costs and services. Then we've got overhead operating costs. So the note here is to be careful not to include the institutional management and overhead costs, such as office rental, CEO's salary, and other general staff. Those go into the overhead costs, which are things like accounting fees, advertising, interest, legal fees, admin staff costs, telephone bills, and travel costs. In the quick scan C, when we're looking at the overhead section, we only include the incremental overheads that are incurred. So if we've had to employ somebody extra at the head office to manage rental collection from the head office side, that will come in as an overhead, but we won't necessarily be apportioning the CEO's salary because the CEO would have been there anyway, so that's not an overhead that's related to the project. The quick scan C focuses on costs that are incurred as a result of the new project being started. Utility costs are the costs of electricity, refuse, sewer, and water. Okay, so those are all on the income statement side. On the balance sheet, a balance sheet is a financial statement that reports the company's assets, liabilities, and shareholders' equity at a point in time at the year end. And and it provides a basis for computing rates of return and evaluating its capital structure. So it's a snapshot at a point in time of what the company owns and what it owes. There's a formula here that is owner's equity equals assets minus liabilities. I suppose that looks like an I, but it should be an L, a capital L. It's a small L. So owner's equity that belongs to the shareholders is your assets minus your liabilities. And it's only ever at a specific point in time. Your income statement or profit loss statement or statement of comprehensive income, they go by various names. Those show the results of your operations over a period of time, normally for a year. But the balance sheet is at one point in time at the year end. Okay, so in your balance sheet, we've got fixed assets, which are long-term assets, like buildings, for instance. That's the asset. If you think of a fruit tree, your tree is your asset, and the fruit it produces, that's your income. And think of the fruit as a short term that goes off. So your income's got to be earned regularly, but your asset, the tree, is a long-term asset. Current assets, that's cash, normally cash and debtors, people who owe you money. So your balance sheet in a property rental company should hopefully have a good amount of cash in it, in your current assets, and you don't want a high debtors figure. The debtors are people who are owing you rentals. You want to keep your debtors figure as low as possible by collecting your rents promptly. So if you've got any debtors, they appear under your current assets. Current liabilities are the amounts due to be paid to creditors within the next 12 months. So those are short-term liabilities. So that will be unpaid invoices at the year end, things like that. Now, then you've got long-term liabilities. These are the financial obligations which become due after more than a year. So if you've taken a loan, for instance, to fund the property, that loan amount will go into your long-term liabilities, and you'll pay that off slowly over time. So hopefully you would see a decreasing trend over time in your amount owing on your long-term loans. Then you've got finally the shareholders' interests, which is share capital plus reserves. So shareholders are called stockholders in America, but that's the sum total which has been contributed by your equity shareholders and the reserves which have been retained in the company. When there is a liquidation of the company, the people to whom money is owed, they are paid first, and the shareholders only get the residual claim from everything that's left over. And if it's a liquidation, there's usually nothing left over because your debts are more than your assets. So the shareholders end up losing their whole investment in most liquidation situations. Okay, let's now go to the term capital expenditure, which is which is sometimes called CapEx for short, which is how you build up your long-term fixed assets. So in a property business, your development costs are normally your main asset, made up of the total costs incurred from the initiation of the project through to implementation. It would include the cost of your land, the buildings, total construction costs, professional fees that go into the build, And well, you'd be budgeting for contingencies as well as part of your planning. But by the time you come to turn it into an asset, those contingencies have either been released or been spent. Different components of that, you can purchase land. You'd include the price paid for the land. If you're a non-vatable entity and you've paid transfer costs or VAT and you can't reclaim it, that transfer cost or VAT would become part of the asset. So you would add it on to what you paid to the seller of the property. Other investigations and legal costs related to the acquisition of the property also fit in under the land cost section. Building costs are your construction costs or your refurbishment costs of properties that are being built in regeneration projects. Then there are professional fees for all the people like architects, land surveyors, quantity surveyors, engineers, all the people who help you to do the development. And it normally comes to about between 10 and 15% of the construction costs. Maybe these notes were written by somebody who's an engineer wanting to see 20% of the construction cost. That's unusual. So we are looking for a lower range, especially in social housing. We find we can keep those costs lower by using the same people over and over because they get used to the product that social housing is delivering. So they become more efficient with their own work and they don't need to charge you as much. So that helps to have those kind of professionals in a sort of a team of preferred professionals. If they've done good work in the past, they've proven their worth. So if you re-engage them, you get good work, and you might get it even at a lower rate than accepting anybody's open tenders. Right, next one. Now we come to the funding side. So funding is the money that lenders and equity holders provide to a business for short and long-term needs. So it can be equity funding in the form of investing money in the company and taking shares, or it can be loan funding. Now, the people listed here, most of those provide loan funding. So, the equity would really belong to the people who started the business. Or if you've got a listed company, they'd be listed on the stock exchange and people are trading in your shares on the exchange. So, breaking those funding sources down, owner's equity. Those who were part of the QuickScan A and B will remember us talking about the contribution that is required by other development agents other than social housing institutions. You've got to have 20% of 20% of your project needs to be funded by owner's equity. And so that is money, either money in your bank account that's not been borrowed. There mustn't be encumbrances attached to it. Encumbrance, the unencumbered part means that you don't have a mortgage bond on any of the assets you own have not been pledged to anybody as security for a loan. So owner's equity can't be something that when money you borrowed, that's going to be the owners of the company have invested that themselves. Land is allowed as your equity contribution. So that can be seen as equity, but you know, you would then still have to show that land as an asset on the other side of your balance sheet. So if you were contributing a property of 10 million, you would have asset of 10 million and you'd have owner's equity of 10 million. Okay, now the debt funding. For a year, we can get money from commercial lenders, or in the social housing environment, the National Housing Finance Corporation has been a big lender. Some banks have also got involved. So you've got a mixture of commercial lenders there. They will give you a term sheet quite early in the process once they've agreed to fund you, and that'll contain all the conditions attached to the repayments of the loan. Grant funding, that's the now called Capital Consolidated Grant, which is administered by the SHRA, and there are two components to it. One is the Restructuring Capital Grant, and one is the Provincial Top-Up Subsidy. So the Restructuring Capital Grant is normally the bigger portion, and the provincial section is less, but together they now make up a massive amount of 426,308 rands. That is a big increase in previous amounts of subsidies. I think to recognize the rapid inflation in building costs. So at least they are keeping pace with that. Other forms of funding, well, if you get donations, those would be recognized as, you know, you'd have cash, and then that would be recognized as equity as well. Probably come into your reserves. You'd have reserves. You'd account for it as a reserve. Right. Next one is some more details about the grants. So there was a SHRA circular in 7th of September, which increased that amount to 426,308, consisting of two components. The Restructuring Capital Grant, 243,000, and the provincial subsidies of 183,000. So if you are successful with a project application as a result of what you've done in your quick scan A and B and C, that's how much you'll be getting per unit. So you've got to still keep your costs down, because what you can't fund out of a subsidy, you've got to fund with loans, and those loans have to be repaid out of your running income over the years. Okay, so next one. Okay, we've covered the share capital part, but this is to tell us that the other delivery agents, that's people other than social housing institutions, are required to provide 20% equity, and that we went through in detail yesterday. Is there anyone who wasn't here yesterday that might need an explanation of how the 20% works for other delivery agents? You can raise your hand if you need that. Okay, so yeah, okay, so we have got somebody who wasn't here. So just for your benefit, social housing institutions don't have to put any equity down into the project, because they basically don't have equity. You know, they weren't funded with a lot of cash to start with, but private sector, the ODAs or other delivery agents who are normally private sector, and they will quite often be people already engaged in property development, or they might be startup in property development, but they will be asked to put in 20% of the development value as project equity. And that can either come from your own cash resources, or it can come from a piece of land that's been brought into the project and been valued. And if that value is 20% of the total development value that's going to be funded, then you can use that as equity as well. But the condition is that it must not have any strings attached in the form of a mortgage bond over that property, or a loan, or you've taken a loan to fund 20% in cash. They do invest. They do some work on that when this is all being assessed. So that's got to be, proper cash, not borrowed cash. Yeah. So, and then the other big component of funding is obviously long-term debt. And you don't have to take long-term debt if you don't need it, but most projects do need long-term debt. So if you can develop for the same amount as the subsidy you're getting, if your cost of your development is at the same as 426,000, well, then you wouldn't need to take debt. But most cases, the development cost is higher than the subsidy, and that's when you've got to go and borrow the difference. There's a limit on how much you should be borrowing as well for the financial health of your company, but we'll deal with that. Just think of 100,000. If you're borrowing more than 100,000, you're going to end up in financial trouble. If you're borrowing less than 100,000, your project should produce enough cash income to be able to fund your loan repayments. Okay. Is everyone okay to move on to performance indicators? Good, no objections. So we'll cover these and then we'll have a short break just after 9, I think. Okay. So there are...
So, Larry, I can see Tabang has a hand up.
Okay.
Perhaps there's a question there. See if I... Tabang, if you can unmute yourself, please come through with a question. No. Okay. Please try again.
Okay, now it's fine. Good morning, colleagues. I would like to know, Mr. Larry, in a scenario whereby as an ODA, and then one happened to be in possession of the land through some 30 years lease agreement with the municipality, how should that land be treated in my statement of my financial position?
Okay, it's an interesting one. Because it's not really a long-term asset, your land availability agreement gives you access to the land. I've not been aware of any cases like that for ODAs. I've been aware of cases like that for social housing institutions. But I think you've probably got a situation here where we should consult about it at the SHRA and get back to you with an answer on that one. Have you had any consultations to date with the SHRA about it?
I suspect not. Tabang is not saying anything.
But that is an interesting...
Yeah.
that's a very interesting angle, and I think we should see how that's going to be viewed, because long leases can also be valued. Like they can come into the balance sheet as an asset. So we shouldn't disregard it, but we must consider it. But I don't think there's been a position taken on it yet.
Oh, okay, thanks. It's well understood.
Okay. Have you had any discussions yourself with them, Tabang, with Ashra, about that?
Not yet, sir.
No, you're breaking new ground there, so well done.
Okay, thanks.
Yeah. Okay. Right. I see Velile asked a question as well. Welcome back, Velile. Nice to see you again. So is Shra expecting us to bring a land parcel with its property valuation report if the land is private? Well, some kind of value needs to be attributed to the land being brought in. So for that, you would need an independent valuation report. Even if it's somebody's own land and not for sale, we'd still need a property valuation done to confirm what the value of that land would be. Does that answer your question, Valia? Yeah, great. Okay, thank you. So should we move on to the performance indicators? So we've got a few that are set out on these pages here. The two most important performance indicators on the quick scan C are the debt service cover ratio and the internal rate of return. So the debt service cover ratio measures the cash available to service debt repayments, which are interest and capital repayments. So once you've got a repayment schedule from your lender, you'll know how much you have to repay every month. And then you've got to cover that from the results of your ongoing operations. So the formula to calculate the debt service cover ratio is your gross income less your operating costs divided by your debt service costs, which are interest and capital repayments. Those who understand financial terms will know of a measure called EBITDA, which is earnings before interest, tax and depreciation and amortization. That's an awful mouthful, but it basically means what we've got in the top half of this ratio here, gross income less operating costs. And that has to be more than 1.3 times your loan repayment. So,
as we discussed.
Hello, yeah.
Are you on mute?
Okay, all right. I thought somebody was having something to add or complaining about the fact that you've got to have 1/3 more than your loan repayments. But it's done, that measure was set at 1.3 for a very good reason. So that you have a buffer to deal with any difficult situations, to deal with a spike in costs or some months you're not collecting the full rent or that kind of stuff. In general commerce, 1.5 is regarded as the normal one. When we set benchmarks for social housing, I've been involved with social housing since the very start and was asked to set a benchmark for a sustainability ratio. Find a measure that's a good measure for financial sustainability. And we chose the debt service cover ratio, and we saw 1.5 is a normal commercial. We said properties should be a more stable thing, so we don't need to have the full 1.5 cover. We could get away with 1.3 cover. So we set 1.3 cover as the measure very early on in the days of social housing. And that was fortuitous, because you'll find that when your debt service cover ratio goes below 1.3, all your other ratios start falling away as well. If you stay above 1.3, all your other ratios are working as well. So it seems to be that we're lucky to find the sweet spot straight away with setting the benchmark at 1.3. And it's remained since then. The project to get into financial distress will find that they're not meeting the 1.3 down the line. It's easy enough to say when you're doing your quick scan C and presenting a positive picture, but you've got to present a realistic picture, because the realism hits you later on if you're not meeting your 1.3. And that's when people get into financial trouble, and you have all sorts of things going on with companies having to be taken over by administrators and that kind of stuff. So remember that 1.3 measure. It works. Then we've got internal rate of return. So this is a standard measure used for for project management and property development. People will always talk about internal rate of return, which is the cash flow return on capital invested in the development. So it looks at your cash flows over an extended period of time and is expressed as an annual rate. The quick scan C has a formula built in, and the formula says prime rate plus 4.5. So I see there's a note about a benchmark minimum here, but the current prime rate is 11.75. So you actually have to be achieving an internal rate of return of 11.75% plus 4.5%. So that gets you to 15.25%. We're hoping that the current environment of high interest rates won't continue too long, that things will start reducing in the years to come pretty soon. Those of us old enough to have lived a long time and had seen many previous cycles will remember the early days of social housing, when interest rates were up around 20% and people were jumping at the opportunity to get a fixed rate of 18% from the NHFC, who were the most friendly lender. So although we aren't used to the rates at the current level from recent times, we have history going back to the late 90s when there was a big spike in interest rates. So for now, we're going to have to meet 15.25 as our internal rate of return. Right, then we've got operating cost per unit per month. And this is very simple. It's simply your total operating costs divided by your number of units in a scheme. It's not a ratio, it's an absolute number. We used to have a ratio called cost income ratio as one of these key measures, but discovered that could hide many things, and settled on changing to operating costs as an absolute number. So the current SHRA benchmark is 1350. It's made up of 950 for operating costs and 400 for overheads. But that's a bit dated. That was set a year or two ago. Anecdotal evidence from people I speak to in social housing tell me that it's around 1,600 Rand this year. So when we're doing our case study, we'll see how it works with 1,600 Rand as your monthly operating costs. Right, then we've got to provide for maintenance. Now, there was a big study done on maintenance being done in South Africa's social housing institutions, and that study settled on the desired amount being our maintenance should be 1.02% of total development cost. So if that's on an annual basis, so that's the figure that's being applied. If in the quick scan C you're putting in a low maintenance figure, when they're doing the assessment, they will bump that maintenance figure up to 1.02%, because that's your long-term maintenance factor that's been calculated. Right, then the other absolute number we use is the development cost, which is the land, construction, and professional fees combined. The Schwab benchmark used to be 400 to 450,000 cost per unit, including that. But the costs have increased quite a lot since that 400 to 450 was set. So the increase in the CCG, the Consolidated Capital Grant, makes development costs of up to 530,000 per unit financially viable, which roughly translates to your subsidy of 426,000 plus roughly 100,000 loan. So if you bear that in mind, that you don't want your development costs to exceed 530,000 per unit, then you'll be okay. But you're going to end up in financial distress if you're spending 700,000 per unit, because then you're going to have to go and borrow well more than the 100,000 you can sustain out of a normal social housing project. Okay, next slide. So we're building some operating indicators into our normal sort of profile of the rentals and what comes off the rentals. So the vacancy percentage is measured by units vacant over total units available. Most SHIs have in the range of 5 to 10%. The default in the quick scan C is 7%. And then we move on to the bad debts provision, where this shows the success in your rent collection. There's different records of success in rent collection across the sector. Those who are able to stand on their own will have a bad debts provision of less than 5%. Quick scan C has a 3.5% assumption, and the best performers have an even lower actual bad debt amount. So that's 3.5% that gets built into quick scan C. Earlier, when I was talking about operating costs, we had a mention of the cost income ratio, which is total operating costs excluding interest paid, divided by total rent and recoveries. And this varies. We used to say that on new build projects, you were looking at 40% cost to income ratio, and on refurbished projects, you were looking at 60% ratio. But it was very difficult to use that as a serious monitor, because you've got projects, early years on a new build, that'll be a low number. But it will increase over time. So with that cost income ratio sort of been settled now to a second level of ratios, not the primary ratios. And if you're doing 50% average, then you should be okay. Yeah. But it does vary, and it's difficult to set a norm for that. Okay. Oh, should we take a break at this stage and come back in 10 minutes? We've made good progress so far. And then we can go to the this important stuff. I want us to be fresh for that. So that's coming up. So should we take a 10-minute break? Come back at 9:10?
Larry, I see that there are hands, two hands
Okay.
that have just come up.
Okay.
I don't know if maybe you want to attend to those first
Sure.
before
Okay, let's do that.
we
Yeah.
take a recess.
First question, is it, there are more. Okay, so there are, right. This looks at Andre's question. Creating an SPV for a SHRA project will be jointly owned by a non-BE company, employee trust, majority black, over 90%. Non-BE company is an established developer and a rental management company. In lieu of its shares in the SPV, the non-BE company will donate the 20% equity, project team expertise and mentorship to drive the build project to completion, rental management, mentorship and maintenance post-project build. Question, what BE level must SPV be at to qualify for the SHRA grant, or what percentage of shares can the SPV give to the non-BE company for their donations? For example, can it give 49% and keep 51%? Andre, from my side, I've not encountered one of these when doing assessments. I wouldn't see a problem with what you're proposing, but I don't know how it's being applied currently at the SHRA. Perhaps somebody from the SHRA could help.
Well, for now, I think it's one of those that would have to take forward because the two of our colleagues who were here yesterday, who assesses these applications as they come in, are not in at this moment, Larry. So we'll just have to get back to whose question was this?
It's Andre. Yeah.
Andre, yeah. With a full answer on.
Sure.
There was a hand though on the chat line.
Okay.
Not in the chat line. There was a hand on the participants list. I think it was James. James, if you can unmute yourself. I have given you speaker's rights. Did we lose James? James Chitenga? Oh, maybe that has been resolved. Was there anything else on the chat line?
Questions here in the chat, John. There's Mandla who's asked, is the DSCR of 1.3 before or after factoring the subsidy? No, that's the subsidy is already part of the calculation because you're borrowing. The debt service cover works on the borrowings, and you're only borrowing what the subsidy can't fund. So the amount you borrow is the difference between the development cost and the subsidy, less the equity if you're an ODA. So that would be after factoring the subsidy. Okay. Muketsi, some costs might be seasonal, therefore is DSCR calculated at the year end or must be maintained throughout the financial year? It's more of a long-term measure, but it can be measured in your monthly management accounts. If you put your indicators into your management accounts, there are some SHRs that monitor it on a monthly basis. It's good practice to put these indicators into your monthly management accounts. It's quite easy if you know the formulas, so your finance person can just add them in a note to your management accounts. But when, you know, that's a measure to guide your own sense of where you are, how you're doing. When you do the SHRA monitoring tool, that's done on a quarterly basis, and it will also calculate the debt service cover. So if you're not doing so well in that quarter, it will appear in your monitoring tool, and you might chat to the SHRA about it. Okay. So James has asked about the chat box. We must have missed James's chat then.
No, I think when he raised the hand, he was just simply saying we need to give consideration to some of the chats that have come through. Okay. So I don't think he had a specific question.
He was reminding us about that. Okay. That's right. About the presentation, yes, Nasizwe, it will be shared probably during the course of next week. Yeah. Okay. Is that,
so if that is all, let's then maybe return at what? It's 10:05 now.
10:15.
10:15.
Yeah.
Okay.
Okay. Thank you. See you then. Can we get started, John?
Yes, I think we are good to go, Larry. Everyone is still here.
Okay. Good. Okay. Sorry about the slightly delayed return from the break. I left my screen on purpose so that you can, anyone who's interested might have been seeing me trying to juggle some numbers in the case study. So I'll tell you about that later. Yeah. Okay, so let's get back to financial viability basics. Right, so this is about financial viability of a project. We need to, what do we need? What costs do we need? We need the estimated cost. We need the estimated net income. We need the and we calculate the estimated return or yield. There are a few components to this. 5 steps of feasibility costing. First step, estimate total development cost. And that we can get help from a quantity surveyor for that. It will probably also give us a cash flow projection. So you'll get a schedule of that. Quantity surveyors are very good at adding up numbers. That's what they do. We would estimate the net income. Now there's guidance from the SHRA on what we estimate as net income. In the QuickScan C model, you've got guidance there on what your rental band should be. We'll go through those a little bit later. Then we've got to look at our return on investment. Then that informs us for our return on investment, which is calculated within the QuickScan C model. We also need to do a risk analysis. I'm not sure if that comes from the QuickScan C model, but that is, we need to have a risk assessment for each project as well.
Larry,
Yes.
so to come in there, there's a request that could you perhaps put your presentation in presentation mode? I think the screen is not. Yeah.
Glenn forgot about that. Right. Where's the presentation mode? We used to have a little picture at the bottom.
Yes,
There
one
it
of those
is.
buttons. There we are.
Yeah, slideshow then. Sorry about that. Didn't. Oh, it was in presentation mode. Oh, that's just next slide, but I don't want to see the next slide. I want to just. Right. Okay, so much better. You can see it much clearer. Okay, so those are your stages of your feasibility costing. So now this is the relationship between the financial KPIs. This is what I was telling you about earlier. This is, to me, this puts everything in one diagram of how one factor affects another. So if we start at the top left, we've calculated our gross development cost, using the estimates from the quantity surveyor. If we are able to claim input VAT, if we've got a VAT registered developer, that comes off. So that gives us our net development cost. Then we apply our subsidy as the first form of funding towards the net development cost. What's left over, we borrow. We get loan funding for that. So if we took an example of the development cost less VAT being 530,000, our subsidy 426,000. So our net development cost would be 430,000. We'd only need to borrow 4,000. If we had a gross development cost of did I say 530? Yeah, 530 minus 430 gives 100 needing loan funding. And so then we get that. Then on that loan funding, we would have to pay interest and loan repayments. But now let's see what we get, what we've got to pay off those interest and capital repayments. So on the right-hand side here, we've got our rental income, less our project operating costs, less our attributable head office overheads. That gets us to net operating income, or EBITDA, as I explained. Some people might call that EBITDA. And if we deduct our interest, that gets us to our net income. So, but that important figure, the net operating income or the EBITDA, is what feeds our internal rate of return, which we then divide by our net development cost, and that gives that measure, net operating income divided by net development cost, gives us our internal rate of return. That's the one that needs to be prime plus 4.5%. Needs to be more than 15.25% internal rate of return. But the other measure that we look at is the debt service cover ratio. So you'll see here that through our operations, we have generated net operating income in cash, and that's got to refund our loan repayments. So those two factors go into our debt service cover ratio, and that has to be more than 1.3. Do you have any questions about this diagram? Does everybody understand how it works? If you have any questions, please raise your hand or put it in the chat. Well, that's wonderful. So everybody understands it. That's very good. That little diagram used to be on the loan officer's desks at one of the mortgage lenders that lends money into inner city regeneration. So it's done the rounds, and it hopefully explains it in a way that's understandable. Oh, I'm trying to get it back on the screen. Oh, okay. Sorry, we've lost our place. Yeah, there we go. Okay. Yeah. Okay, so we'll move on to the next one. Now we'll go navigating through the QuickScan C model. There's some snapshots here on what the model looks like. We'll be going through the model real time a bit later, but this is an introduction to it. So let me just get my notes next to me here. Okay. So there are a few components that go into the model, and you need, when you're doing the model, make sure you've got this checklist of information ready. So the first is the ownership structure for your ODA or your SHI. So there's a section on the ownership structure where you have to enter that. Then you look at your feasibility costing. This goes into your construction schedule, your CapEx schedule, where you've got sections for land costs and legal fees, construction costs, professional fees, sundry development costs. And that goes into your CapEx schedule. Then we've got our debt terms. So hopefully you've got a simple debt structure. It's quantum of debt, the terms of repayment, normally 20 years in this environment, interest rate, normally prime plus a few %. Then there's some arranging fees that are done. The QuickScan C was developed by a treasury specialist who used to work in a merchant bank. And you can see that comes through with taking the full set of how the bank would look at it with all the extra premiums added on. So you're well catered for and won't find any surprises that you normally do when you go to the banks. You think you're just paying the interest rate, but then you suddenly discover that they've got another fee for initiation, another fee for admin, all these pieces. So you end up with getting a surprise, but you won't have a surprise once you've done the QuickScan C, because that's all taken care of. Then you've got to look at your income sources. So you've got your social housing, residential, rental split into the income bands. You've got a section for your parking rental. You've got a section for commercial rental, normally shops on the ground floor. Oops. Then you've got to know what your basic unit layout is. So you'll have number of units you'll have your architectural drawings, you'll have your number of units per floor, you'll have your number of primary versus secondary units. And that's all split out nicely for you in the QuickScan C. Then you're going to have long-term maintenance plans. So that thing of the 1.02% of development cost, that's your long-term plan. So basically what you would do when doing that in the QuickScan C, you would put in a provision for maintenance, but you might need to, your long-term maintenance plan should pick that up and top up your 1.02% to top up for the balance of maintenance up to the 1.02%. And if you don't do it yourself, you'll find that when it's being assessed by the SHRA, the assessors of the QuickScan C will add an extra component to the maintenance to make sure that you're covering the full 1.02%. Okay, so we'll move on to the next slide. So this is also showing the different components to the model. So we've got there's an instruction section on the first page. Then you do your inputs only on 2 sheets, CapEx inputs and general inputs. And in those tabs, there are fields that are highlighted in yellow. You only are allowed to change inside the yellow fields. You'll see that sheet's been protected, that you can't put in any other changes elsewhere. If you need to make notes, you'll have to do that in a separate place. For instance, if you're adding up different costs together to get to a total, you'll need to do that outside of the QuickScan C. The blue coded text can only be adjusted by the SHRA. They know the password. I hope somebody at the SHRA is going to share that password with me one day, but no chance of that. Model based on the 20-year time horizon. So that's the 20-year loan repayment period. That's normal. So we have to do a 20-year model to see that your loan, follow the period for full repayment of your loan. Unfortunately, it doesn't allow for phased development. So if you're doing a phase 1, phase 2, phase 3, you would normally apply for them separately. But you'd need to discuss that with the SHRA if you wanted to do one combined application. But you probably would find that you're more likely to have to apply for each phase separately. Okay, on the CapEx input sheet, there's a section for the insertion of the development costs. These are in monthly time periods. It's a 24-month time period. And it also has got a section for including income earned during construction. So if you've got if you've got a development, and this is what normally happens, if you've got an estate of 3-story walk-ups and block A to C are ready in November, and block B, E, and F are going to be ready in January, you want to get people into the blocks A and B and C in November already. So you might have 2 months rental to put into your model. And then, the full handover will happen after the remaining blocks. So under those circumstances, you would include some income during your development period. It does wonders for your ratios as well. So don't lose the opportunity to show income during your development period if you are occupying some units sooner. Under general inputs, lots of rows to input there. There's some general project information. There's a place for your funding structure, and then there are lots of line items for operating income and expenditure. And these would always include that, because your project is going to be, you're providing exempt income as rental. So you wouldn't be able to have a VAT claim on your operating costs because you're providing an exempt supply. It's only on your construction costs we can claim it in that window. So on the summary sheet, the summary sheet includes everything, all on one page, nicely set out. So in there you'll see your IRR, you see how you're doing with your maintenance expenditure. You'll see what your maintenance costs are, your debt service cover ratio. You will, and it's been formatted to highlight it if there's a problem. You'll get the colors will change. There's some other tabs, those are just for internal use by the SHRA and not to be used by the applicants. Okay, this is just a picture format of what we've just been through. So there's your project information on sheet 1, financial information, Then we've got the revenue, your allocation of units, and your rentals all go into there's a table for your revenue. There's a space for entering detailed operating costs and overheads. And then there's a separate sheet for your capital expenditure. And then these are all summarized. These all feed into the summary sheet where your key parameters are shown. Just some terms that are used in the model that some people might not be familiar with. There's a term used in the table where you're inserting your rentals. There's a term used, rent quote, which that is the maximum amount of monthly income that can be spent on residential rental. There's a default that's been entered by the SHRA. You should only adjust that if you discuss it with the SHRA. And you'll see that it does vary between lower income bands and higher income bands. The reason being that a person on lower income still has to spend food and whatever, and there's less available to spend on accommodation costs. And the higher income bands, they will have a greater proportion of their salary able to be spent on income bands. That's if they haven't bought a fancy car and they are paying off big amounts on a fancy car or something like that. So it's not, there's been a bit of a trend to notice that those earning a higher level of the income have got less income available to spend on accommodation. But that's just through their own poor management of their financial affairs. So the rent quote is your maximum that people in that income band can spend on rent. It used to be a generic 30% applied, but over time the realization has been that we need to make it variable for different income bands. Okay, then we've got a short-term grant retention facility. So the SHRA model contains a 10% retention on the drawdown of the subsidy, and then the balance of 10% is paid out once the project is complete. So that's built into the model. Swap costs, this is in the financing section. So if you're entering into complex financing deal, such as the cost of fixing an interest rate, and they're using interest swaps to be able, the financing institutions are using interest swaps to do that, you'll see there's a swap cost that's applied. Then you'll also see the term tax wear and tear. That is where you've got different allowances for tax purposes on buildings that get applied even if you're not doing depreciation in your income statement. The tax calculation has that. That would only apply to you if you are an ODA with taxable status. A social housing institution isn't automatically exempt from tax, by the way. You can only be exempt from tax if you are also declared a public benefit organization, a PBO. And that requires an application to SARS justifying why you shouldn't have to pay tax. Okay, so yeah, in the quick scan C, this is the first of the sheets, the project information. It's got your project name, project commencement date. It's got the construction period in number of months, and that will automatically calculate your construction end date. You put your applicant name in there, which is the company name. You answer the question, are you an existing SHI? If you're brand new, no. Do you have a public benefit qualification? Yes or no. Being a old style Section 21 company or not-for-profit company does not entitle you to be a public benefit organization. It's not automatic. You have to do the public benefit organization application separately. Is the entity a vet vendor? Yes or no? So you answer those questions. Then we go to the location. So you put your province, different types of project, if it's a new build or a refurbishment, number of stories, earth size, earth size in hectares. So you'll have if you're in a city, you want to have a big earth size, so you just have to put 1 hectare, I presume. Number of units, you enter that. Okay, your cost of VAT will you see that's not in yellow. That comes through the other inputs that you've done. But do you have to pay corporation tax? An ODA generally will have to pay corporation tax, but a social housing institution who's a public benefit organization will answer no to that question. Okay, so that's your project information. Now we go to the financing information. If you're an ODA, you'll have your equity contribution amount entered there. And then if part of your equity is in shareholder loans, then you put that proportion in there. Bit of a grey area where the shareholder loans are allowed. There'll be investigation done into that, and if any part of that is from borrowed money provided by the shareholders, it won't be allowed. Arranging and underwriting fees, prohibition on prepayment of equity for a number of years. If there's a rate that they need to earn income on those shareholders' loans, well, you'd put that in there as well. But shareholders' loans would only be allowed if they are more akin to equity than more akin to loans that are going to be repaid. So then we've got more information on the right-hand side about arranging and underwriting fees, the swap costs, the bank costs, and then the margin over prime that is on those loans. If we go down to the bottom section to the debt, long-term bank debt, in this case they've got a 15-year loan, not a 20-year loan. In the example that was used for these, you put your facility side in, you put your margin over prime percent in this case 1.5. That's during construction. And then sometimes you have got a different rate in between construction period and operational period. So in this case, it was a margin over prime 1.5 during construction, a margin 2% after construction. Once again, there's provision for arranging and underwriting fees, commitment fees, swap costs, bank costs. So as I said, the Treasury modeling consultant knows all the layers of costs that get added by the banks. So this was kindly put into this model. It makes entering this section a bit intimidating, but at least you know you're not going to be caught by surprise by the banks. There's an interest grace period. If there is an interest grace period or not, the 1.3 debt service cover is obviously been entered in. And then if you've got second form of bank debt, you would enter the same in the other column. Right. Oh, the question of VAT. Okay. This is an area where some people have set up the structure of their group with an entity that is a developer in the group, and that allows them to have a VAT registration and be able to deduct VAT on construction costs. With social housing being such a marginal operation, this helps some organizations to remain viable and not, to avoid getting into overstressing long-term debt. So apologies for the busy slide here. We've probably tried to get too much into one slide. You answer the questions in the quick scan C, like it is on the right-hand side. In this case, it was all no's, but if you are VATable, you would answer yes to the second question, VAT reclaimable on capital expenditure. So, and probably yes to the first question as well. So the VAT, it doesn't matter if you're a public benefit organization or not. Public benefit organization only matters for company tax, income tax, in other words. VAT chargeable on residential rental services. Default is no. Residential rental is always VAT exempt. And I'll explain in the notes when we go through the difference between zero rated and exempt and why it's important to draw the distinction. If you're a VAT vendor, if you do commercial services such as commercial rental, you would answer yes to this next question. VAT chargeable on revenue during construction. Well, that's if you're letting your shops, if you're refurbishing the upper floors of an inner city building and the shops are still going downstairs, then you would answer yes to that question if you are a VAT vendor. VAT reclaimable residential operating costs? No, that would always be no. VAT claimable on commercial operating costs? Yes, but you would have to define those commercial operating costs in the inputs that you provide. Okay, so those are how you answer the questions in the top right. Let's go through these bullet points one by one. So value-added tax is a consumption tax placed on a product whenever value is added at each stage of the supply chain, from production to point of sale. So each person providing a VATable service along the line will just have to add VAT to their invoices so that along the chain everyone pays a little bit. And the next one can recover it. So the receiver gets their pound of flesh right at the end when the VATable product is done, which in a development scenario, the property developer would be paying output VAT when they sell the project on to the social housing institution. But there's a way of selling that at the net cost, so you save a whole lot of VAT. Okay, only registered VAT vendors need to consider VAT in their accounts. Entities not registered for VAT do not charge output VAT, but add input VAT to the cost they incur. So but in your operating costs, for instance, if you pay 115 Rand, or let's say an accounting fee, if you were a VAT vendor, you would show 100 Rand paid for that and 15 Rand would go to your VAT account. But if you're not a VAT vendor, you show the full 115 Rand as the cost of your accounting fee. some people have a separate line item where they might say input VAT paid. Other people, if they're not registered, they shouldn't really bother with that side of things. Just recognize the full 115 Rand as your fee. Saves you the trouble of allocating everything between VAT you're not going to be able to reclaim and the cost. Okay, now VAT is either charged at the standard rate of 15%, such as in our environment, commercial rent or property sales, or I mean, there's transfer. You could either charge VAT or transfer duty for sales, but let's not bring transfer duty into this. Your standard rate is 15%, or you've got VAT chargeable at 0%. That's called zero rated, and that is important to draw a distinction between zero rated VAT charged at 0%, such as government grants, and because your projects through the SHRA are funded by government grants, you're entitled to this VAT benefit of being able to arrange things that you can have a VAT claim. And then when it comes to exempt from VAT, some suppliers are exempt from VAT. Residential rent is exempt from VAT. It might appear to be similar to zero rating because you're not adding anything, but it is different. It's important to remember that it's different. So due to the business of residential rental being an exempt supply, the VAT charged on development costs incurred by SHI to develop its own residential projects for itself is not recoverable. So no input VAT can be claimed. However, if the development costs are incurred by the property developer, who also receives subsidy in an arrangement with a SHRA accredited entity, the VAT incurred by the developer can be recovered up to the amount of the subsidy when the property is transferred to the rental landlord. And the developer will have to add VAT to the selling price. The selling price can be based on the net cost after deduction of the subsidy. The amount of the VAT saved in this ratio is the amount of VAT saved is the ratio between the subsidy. Between the subsidy, I'll just have to revert back to the. I'll have to revert out of that to get the bottom two rows in. The selling price can be based on the net cost after deduction of the subsidy. The amount of the VAT saved in this is in the ratio between the subsidy and the total development cost. So you'll see there's a significant benefit there. It's a good few million rand that can be saved. And that is because the government grants are zero rated. That's been cleared by the Treasury. I was in meetings at the Treasury, making sure this was all okay, and it has all been fine. So there's no problem on that. There is a school of thought that says because it's government grant, you shouldn't be getting the VAT back. But you know what? This allows that government grant to be used twice. The first time it's used is used to develop the property. Then you get the VAT refund, and that gives you extra things to add things to the property. So I know where these refunds were used to add extra things to the children's playground and all these other kind of community benefits that happened. So that is, there's a double benefit. There was a mission at one stage, a high-level delegation from social housing that went to the Minister of Finance. And the Minister of Finance didn't see this argument. So he wasn't pleased. with the people who went to see him. But he had blinkers on, and I hope he doesn't still have blinkers on. This was a good few finance ministers ago, by the way, and I won't mention any names. Yeah. So the VAT has trod a long and winding path, but it does work, and it's worth getting yourself structured that you can do it like that. Right. So perhaps we should just see if there are any questions right now. No, the last one was to expand the screen, so that's still there.
Okay, ladies and gents, at this point, then let's us see if on the ground that's far covered, if there are any questions, comments, before we move on to the next section. I note the first hand that is up. Let's see if there are any more. Going once and going twice. Okay, I think let's take you, Nonhlaza. If you just unmute yourself, your mic has been enabled.
Thank you so much. Larry, just on the VAT issue, and the SHI be registered as a VAT vendor and not use a developer company. Thank you.
Nonhlahla, were you saying there is a SHI registered as a VAT vendor, or you are asking a question if the SHI can register as a VAT vendor?
Yes, can the SHI register?
Not normally, no. No, the SHI would not normally be able to register as a VAT vendor itself, because your primary operation is the provision of an exempt supply, being residential rental. It's probably unlikely if you had a big commercial component that you would get that VAT registration, even if you had a big commercial component, because your primary supplier as a SHI is still the provision of residential rental as an exempt supply. You'd need to have a separate company. You need to create a group structure where you have a development company who is developing land for sale. Land for sale is, property for sale is a VATable supply. So you would be able to get registration for that company, but in the agreement for the subsidy, you would need to involve the SHI and the development company. You have it's called a tripartite agreement. And these have been in operation for a long time. There's an established practice to do that. So if you were prepared to go through that route to set up the separate development company, that would be possible. Does that help, Nonhlaza?
Yes, thank you so much.
Yeah. As an ODA, your VAT status would be determined by the primary purpose of your company anyway. So if you were already a rental landlord providing residential property, you probably wouldn't have VAT registration. You would have VAT registration only if you were developing properties for sale. So you'd need to have that development for sale aspect in the ODA as well. Is everyone happy with the VAT explanation? Okay.
Okay, I don't pick up any new questions on the chat line, Larry. So
Okay.
I assume that there isn't any. I have escalated that one on the SPV, so we await the response, a full response on it that we can then share with the group.
Okay. Fine. Are we okay to proceed? What I'm planning to do is just go through the rest of the slides on the, and then we go in the, then we'll have a break, and then we'll have a case study session in the quick scan C model itself after the break. Okay. Right, so let's continue. Okay, so we're dealing with a revenue now in the quick scan C. There are 5 income bands. 2 are in the primary market and 3 in the secondary market. 30% of the units must be for the primary market, which is people earning between 1,870 and 6,700. And then 70% in the secondary market. If you have a development where you've got market rent units and all of that kind of stuff, those don't form part of this this assessment. We're assessing the social housing units only. So let's look now at what we have to enter here. So we're meant to have a spread across the bands. So the default that's been entered in the blue text is 5% in the very lowest band, and that rent quote is 27%. So 27% of the rental income can go to accommodation. So the minimum rent is 505, maximum rent 945, average rent 725. Next band up, 25% of our units must be in that band. They can spend 29% of their rent, so of their income on rent. So minimum rent is 1015, maximum rent 1943 for that band, average 1479. And so that's 30% of the development must be for that market. You're obviously going to have, you're never going to have these matchups exactly, but you try and use this as a guide as to where to steer your marketing efforts. So secondary market 6701 to 11,300. 25% of your units can be in that band. You can go up to 31% of income as rental. Minimum rent 2077, maximum rent 3503, average 2790. Next band up is 11,301 to 15,000. 30% in that band. Rent quote can go up to 33% of income. Minimum 3729, maximum 4950, average 4340. Next band 15,000 to 22,000. We've got a lower income spread there. We've got a rent quote of 35%, minimum rent 5250, maximum rent 7,700, average 6475. Now you might say for project viability on a spreadsheet, why don't we just whack everything into the top section there, and get as much rent as we can? 2 reasons why not. One is the intention of social housing is to make it accessible to a wide level of income levels. The other is that when you're getting into this income range and you're seeing these rentals here, there's competition from the market rental sector. So many of the people earning in this band have already got accommodation. and they're paying accommodation at market rates. So there are not as many of them around as one might like to think. Yeah. So this average, this indicator says that's what your ratio is of your primary units to secondary units. So if that's less than 30%, you'll get a warning. If it's more than 30%, nothing will happen. It'll just sit there. Then we've got to go to the next part of this table is to the right on the spreadsheet, but it's too wide to bring into a slide. So we bring in there, you fill in your different types. We've got bachelor flat studio, 1 bed, 2 bed, 3 bed, and then there might be different types in there, different dimensions. So we put that information into there. And that populates our table for number of units and for income levels. This is a slide just to highlight the 30% and 70% split that we've already spoken about, split between primary and secondary. And this slide is about more detail on how to enter the units. We briefly covered that on the previous slide. We've got the unit size is the top row of the yellow section, so that's the square meters, and then the bottom two rows on the primary section are the number of units of that size. So in this case, we've got a 30 square meter unit of a bachelor flat, 5 people occupying that one. We've got a type 2 is 32 square meters, and we've got 25 people occupying that one. Then if we go to secondary market, we've got 30 square meters and 32 square meters, but nobody occupying those. And we've got 1 beds at 35 square meters, and there are 25 people occupying those. So that's how to enter this table about the occupants. Yeah, and we mentioned about the weighted average rental quote is, in this case, it's the average of all of these it's these percentages multiplied by the number of units, and that comes out average for the group is 32.1%. You'll get an error message if that average exceeds 33%. Yeah, so you would then enter your vacancy rate there as well. And you're going to make sure that your 30% of primary units in the development are 30% or more. And so that's all feedback on stuff you've entered. So you can check that everything is fine there and not pick up any error messages from what you've entered. Right, so we're done with the revenue side. We're now dealing with the operating costs. And we're dealing first with direct operating expenses. These are all the projects all the expenses that are in and around the project. So it's operational costs, security, caretaker, salary for the building, maintenance of the building, whether maintenance is done in-house or outsourced. You might have salaries of maintenance workers if you're doing it in-house, or you'll have outsourced maintenance costs. Those are your direct operating expenses. The overhead costs are those associated with running the business that can't be linked to creating or producing this product or this service or that development. So they might be general, but if you've had to employ somebody extra to look after rent collections at the head office, you would add that in as an attributable overhead when you're doing the Quick Scan C, because that person's position wouldn't exist if it wasn't for this project being added. Yes, and then we've got, when we enter our direct operating costs, we've got a facility to enter everything on a line-by-line basis. So you would put your annual cost in here. The model would then calculate your annual cost per unit, and then it would do a monthly cost per unit. You'll remember we had a benchmark for the operating costs, and we said it was roughly 1,300 to 1,600. That's per unit per month. So that would be the total that comes. We would be comparing the totals that come out here on the right-hand side. This example is a bit dated, so those costs are lower than what they would be now. Don't be worried about the numbers, the actual numbers. In this example, we enter, well, in the Quick Scan C as well, we enter annual costs in the yellow column here, except for provision for bad debts, where we enter a percentage in the middle column. And so that's your expected provision for bad debts. That's different to vacancy. Vacancy you've entered elsewhere. This is where you're expecting to write off debts of people who haven't paid for a period of time. And if you've got any other costs that aren't listed here, you can specify them in the yellow block below. Okay, so now we deal with the overheads. Don't try and read what's in that. It's a very long list and a very detailed list, but the expenses are more for accounting services, bank charges, computer software support, employment costs, salaries, insurance. This is insurance of the head office. Insurance on the project itself would go under the project operating costs. So you'd see that insurance should be shown here as, yes, there we go, homeowners insurance on the development. So insurance of the project itself goes into the operating costs. This insurance is general company insurance, which will probably be for the head office and third party and all that stuff. So postage and courier and marketing are the normal sort of head office costs. So in this case, we had quite a long list populated. And in that case, we had 753 monthly cost per unit, and it looks like 591 in terms of operating costs. This varies greatly from one company to the next. Right, now we get to entering the information for the capital costs. So we have entered the date, the start date. Remember, we entered the start date on the initial input sheet. That goes into our date into our date cells, and then things run automatically from then on. So typically the projects are between 8 and 24 months. The maximum period allowed in the quick scan C is 24 months. If you do run past 24 months, you can enter a big number in the 24th month. You know, if it was going to be a big project taking 3 years, I don't think you'll be able to insert columns to move your 24 months to 36 months, but just make your month 24 then equal to month 24 to 36, you know, put that in. There's not much else we can do about that, but it's rare to have such a long development project. The values entered should be excluding VAT. The model automatically adjusts for your VAT according to the settings you've entered. Land costs typically at the start of the period. Legal transfer costs go together with those, so you'll generally find those are upfront. You insert your revenue and overheads incurred during the construction phase. So you'll have rates and taxes, you'll have insurance, you might have a management cost. You put those into this as well, because you'll still be paying rates while you are doing your construction, all that kind of stuff. Those don't stop. And then when it comes to doing your detailed building costs, ideally you'll have at that stage you'll have an estimated, you'll have your QS estimates, put them in as much detail as you're able to. There's provision for detail that serves for most companies, but there is a section at the bottom of each of the subsections here where you can enter one-off line items for yourselves that pertain to your entity. Right, so those were the inputs. We're now going to the summary page, and that you see ODAs are to ensure that you've got 20% in this section here. So in this case, your share capital is 15,000. It's only 7.8%. Where are you going to make up the difference here? I can't see where it's been made, where the rest of that difference is being made up. So maybe this quick scan C would still be in a non-compliant position. Yeah, you would, if you were in this situation, you'd have to explain why you're not meeting the 20% and how you're going to meet the 20%. So then the one side of it is the source of funds. So that shows your equity, your shareholders' loans, your bank debt, your restructuring capital grant. It shows your provincial contribution. If you've got a project staff gear up grant, you might show that there. Any other grants or donations would be shown there under and that gives you your financing total available. But then you apply those funds to make payments for your capital expenditure. So that 192 million is being spent on the 168 capex, and there's 23 million of that, which you would then get back and would become. The VAT is like a revolving credit account within your development profile. And I'll show you how that works when we get there. We can't make any adjustments to it, but it's in the financing sheet in the quick scan C. Oh yes, I forgot about the interest, your capitalized interest during construction, that gets put into here, and any of your other upfront financing fees. So all those layers of fees that were in the finance section that we went through earlier, they would all come in here because they ultimately get capitalized to the value of the to the value of the project. Yeah, so then we get to these key parameters, and if we could just take a few minutes to go through those, and we take a break at 10:30, if that's okay. So these, you get a green tick in the box or a red X in the box if you don't meet it. So primary target units, 30%, 30.1%, we get a green tick. Average monthly residential operating cost must be above 1,300. You might think we'd want it to be below 1,300, but why it needs to be above is because if you're not spending 1,300 on operating costs, you're probably not providing a good service. So it's in everyone's interest for you to be providing that good service. So you'll get a green tick because you're 1301. So you'll be fine. Then this maintenance as percent of capital cost must be at least 1.02%. Ours comes in at 1.08%, yeah. In this example, project IRR, remember that's got to be 4.5% above prime. So in this case, we had a target of 13.5. We were achieving 14.6, so we were okay. Debt service cover ratio must be at least 1.3. In this case, we were getting 1.34. Yeah, so there are notes here to say what you must do if you don't meet those things. So remember the diagram we had where all the different factors flow into the debt service cover and the IRR? You see that what do you do if you're not meeting those? Then you go through a layered process. We review the rental. We review the direct costs and overhead assumptions. We review the financing structure, and we review the project. And finally, we review the project costs. So once you've trimmed everything else, you then might need to trim your development cost. And you'll find that it flows through all those relationships and you come out at something that works. So if you're starting with a development cost of 700,000, nothing's going to work. But still go through the process of reviewing that you've got your rentals right, reviewing that your op costs are in that sort of 13 to 1,600 zone. Look at your financing structure, your debt terms. If you need to extend your debt term, if you need to repay over a longer period, that's one way of doing it, if the banks will let you. And then finally, then you know how much you've got to reduce your project costs by once you've been through the layered process of looking at all the other things you can do. Why do quick scan Cs fail? Those who don't meet the targets. One is information not provided accurately. Information could be outdated. There could be a missing debt funding term sheet. This is now answering from the assessor's side. Why do some quick scan Cs that get submitted fail? So these are the reasons: outdated information, the debt funding term sheet might not be there or not be complete, lack of a proof of equity. Remember we said you've got to prove that it's your own equity, it's not borrowed equity, or there's no elemental estimate. So that's in terms of information provision. If you've submitted a full application and you've done your checklists, you shouldn't have a problem with these because you would have checked that your information is all there. The other reason they fail is they don't meet the key performance indicators. So they don't meet the project IRR of prime plus 4.5%. They might not meet the debt service cover. So you might still have a red cross on your summary sheet for IRR and debt service cover. Or you don't meet the maintenance reserve. Or your operating costs are too low to allow proper management of the project. A guideline of 1,300 to 1,600. On the other hand, if you've got operating costs, there are some entities who have operating costs of over 3,000 Rand per month, but they're obviously failing. They fail all the tests anyway, so they don't get funding if you're coming along with that. But those are things that are picked up at the monitoring stage. So those are companies that are not being run efficiently, and they then engage with the SHRA to try and get them to run efficiently. But that's only picked up at the monitoring stage. You wouldn't be doing that kind of stuff. You wouldn't pass the test here if you had that an operating cost of 3,000 per unit per month. Other reasons for failing, causing financial pressure, are you've got unrealistic capital expenditure costs or unrealistic operating expenditure costs. Those examples have already been mentioned. Right, so if you've done all your work and you've got all your backup and you've got the right things in, you'll find that you get lots of green ticks on your summary page and you won't have any red crosses. So with that, I don't know about you, but I'm ready to take a break. We're going to take the next break. I think we actually might be doing well because the last hour was meant to be for where are we now? We're at 11:30 now. So the practical, that can be, we can finish that. I don't think we'll need more than an hour to do the practical, but so let's take a 15-minute break, but we want to check before that whether there are any people asking questions.
Okay, I see on the hands, Larry, that there is one hand up. I did note that on the chat line, there was also another question there. So perhaps we could attend to that and at 1:30 then take that 15 minutes break. Loiso, please unmute your mic and ask your question.
Thank you, John. I think my question, before the question itself, I think today we are talking too much about the numbers, and if participation there is minimal. You see, I think when it comes to numbers, I think we first digest, or else get the hard copy of it closer so that you go through and then you grasp. I think very soon we will understand the presentation when we get those material. But a question that asks why quick scan C fail. I've seen the explanation there why, but according to your site, other than us going to the professionals and whatsoever kind of, don't you have the standard template whereby we can tick all the box, or else a template that is friendly user for us to use so that we minimize this failure that we're talking about? Thank you.
Okay, thanks, Lisa, for the question. you can't really have a generic guide for everything because circumstances are different in different regions. So that's very difficult to do, other than give you this template for you to complete. Once you get used to it, it is then quite easy to complete. The difficult part is doing the first one. So it's a matter of then making yourself comfortable with it by using it. And there will be more guidance that reaches you soon as well. So it will be easier once you've got that next to you. But to put in guidelines in terms of what you should be entering, that's difficult because of the big variation in how people do things. All we can do is basically, provide that sort of guideline of your operating costs between 13 and 1600, and your development costs shouldn't be more than subsidy plus a loan of 100,000. Those are the kind of things that we know work. But you would need to do your entries into the model with that in mind. From your QS costing and all of that stuff, you would enter that as it stands, and then you would need to juggle things as you see that you're not meeting certain criteria. Does that help, Loisa, or would you like something more?
No. I think I'm covered. I
Okay.
thought maybe something can be done, but you explain it. So
Yeah, it's. I think it really needs to be entered by you as well. It's also a demonstration of how well you know what you're doing. So that needs to come from the applicant. There was another one in the chat also. Belile. When we start construction, we demolished 3 old and debilitated hostels, and some part of the land we still need some refill as part of stabilizing so that we can be able to build strong foundations. Are we expected to use SHRA grant funding, especially on the ground stabilization? I'm not aware of any special funding that is attributable to that. As far as I know, it's all got to come out of that funding. I've seen some people have to pay for their own bulk infrastructure, which you would normally want the municipality to pay for. Even that kind of stuff might not be covered by the municipality, but you would have to cover it out of the grant. So you would have to organize your development costs so that you can cover it, or find other funding to cover those. But I'm not aware of anything special grant for that. What I do know is that there were some kinds of special things, like the people at the coast used to get a condensation grant because the rain comes from the side there. So they have to put extra fill between, it's all got to be double brick walls, and then with reinforcing and with a plastic sheet in the middle, in that gap between the 2 bricks. And that they used to get an extra subsidy for that. That's now going to fall away as well with the new subsidy bands, because it's all been simplified. You're getting extra money, make it work. That appears to be the kind of philosophy that's being adopted now. So I'm afraid I can't give you an answer you might want to see, Felile. Yeah. Okay, if the land is the government's property, well, you need to engage with the government officials. see how you can twist their arms to help you. Yeah. Okay. Andre wants all the costs updated to current. Okay. That yeah. Right. That's a good plan, because these slides have become a bit dated. Does the caretaker rent also? Right. Well, that you might have a caretaker living on the property. He would either be paying a reduced rent, he or she would be paying a reduced rent or no rent. Depends on the deal that you've got with a caretaker. So you build that into your rental income here as well. What qualifications? Well, I don't know if that would be dependent on each organization yourselves. Some caretakers are highly qualified, some have no qualified. Well, the important thing is that they can do their work, you know. They can be the handyman fixing things. They can raise questions to the management when they need to be raised, all that kind of stuff. So I don't think there's a blueprint on what qualifications they need. What must we expect when we are called by the city planning and development of the local municipality for town planning approval? You need that support from your local government, but all your interactions with the local government are between your entity and the government and local government. I don't think SHRA gets involved in operating on your behalf, doing any advocacy on your behalf with the local government. Maybe in a special situation, but normally the rule would be that they don't get involved, that you've got to engage with yourself in different spheres of government. Does that answer your questions? Who was that? That's Velile. Yeah. Okay. I think it's time to break. Okay, we've moved past 10:30. So should we come back at 10:50, 10 to 12? 12 minutes break. Okay, see you at 10 to 12. Okay, is everyone ready to restart? John, are you there?
I am here,
Okay, excellent. Yeah.
we still have a majority of the people in the room. I guess we should straight to it.
Okay, very good. So we've got an hour and 10 minutes now for the next session, which is the real live case study. Well, it's just numbers, but it's real live on QuickScan C. Tatenda and I've been polishing up a few things on it in the break, and I'm happy to say that the model seems to be back in shape like it was. We had a bit of a wobbly because of the latest version, but we've managed to rescue it at the last minute. So we are back on board. So just going through those slides that we had. Remember, we spoke about the overview. It's just got a general overview, and then it's got instructions of what to do on each sheet. But we're not going to spend too much time on that. We're rather going to go to the actual sheets where we do the stuff. So the first one is the general inputs. And what we just call this case study. Said project commencement date, 1st of September 2023. Construction period 18 months, so it'll finish 31 March 2025. Applicant name, we've called it GQ Housing, because that's where I'm from. I used to be from PE, I'm now from GQ. Is the applicant an existing SHI? No. Does it qualify as a public benefit organization? We've said no. Does it as a VAT vendor? We've brought the VAT complexity in. We've said it is a VAT vendor. We're assuming it's an ODA VAT vendor, because, yeah, we're assuming that most of the people listening are ODAs, or certainly if you're in SHI, you need, it would be useful to know the VAT option. So in this case, GQ is in the Eastern Cape. It's a new bold project. You've got a choice there of which provinces. I mean, which buildings? No, you don't. I thought it was a drop-down list. It's a drop-down list on the QSA, not on the QSC. 3-story, we've got 3-story walk-ups. I've just put in an earth size, and assuming it's an estate area, you know, open greenfields, 132 units. Cost of land was that amount, because that's the amount we had from the case study from QuickScan A. I think QuickScan A, it was actually for a inner city project, but we've just used the same costs here. Corporate tax payable, we've said yes, because we're not a public benefit organization. Right, we need to do 20% equity. So I've taken the total from CapEx inputs, I've put in 20%. Taken 20% of that total CapEx number, and I've said 20%. So hopefully that works through nicely. Haven't made anything on shareholders' loans, nothing fancy, no underwriting and arranging. No prohibition on equity. If there is a hurdle rate, shareholders normally looking for 20% on their return, but it doesn't matter because there's no shareholders loans anyway. So we're just assuming this is equity contribution. So in this case, there's no arranging and underwriting fees, no swap costs, no other bank costs. Margin above prime on the shareholders' loans. If we had shareholders' loans, well, that 4% was entered in the default. Right, if we're going to arrange long-term debt, that's going to be over 20 years. I've just entered a facility size to make sure we've got enough to cover our possible loan that we might have to take. If you enter 0 year, you'll get a message on the summary page to say you've exceeded your facility. So I've built in a facility of 15 million. All these different rates, these are defaults entered into the QuickScan C as you would get it. Yeah, no commitment fees, swap costs known, principal grace period. Haven't assumed any grace periods, and we've got a 1.3 debt service cover we need to cover for that loan as from the central entries. We could have a second and a third loan, but we we're not going to populate those today. So the base interest rate, that's the current prime rate, which is entered by the SHRA and updated every time you get sent a quick scan C. And there's a margin above prime on retention funding during construction. 1% is the default. No arranging, underwriting or commitment fees. No swap costs, and there's a 0.3% bank figure which is entered in there. So this is basically like a revolving fund in your construction period, and you get the grant retention back at the end of the period. With and there's a bit of an interest charge on it while it's in the system. Okay, so then we've got that. Then we come to the VAT question. So the version issued in I don't know if any of you have received the version issued in September. That raised a number of questions, mainly around the VAT, and I know that the SHRA is busy working on that. They gave us a version last night. They gave us the version of, or this morning they gave us the version that is got the VAT put back in. They did think the VAT wasn't necessary at one stage, but we've had a discussion and they putting it back in. So the second question had been hidden, so it's now not hidden anymore. So we're answering yes for VAT on land and buildings, VAT claimable on capital expenditure. We're not a public benefit organisation. There's obviously no charge on residential rental, VAT chargeable on commercial services. Yes, we would have VAT chargeable on commercial if we were having any commercial rent. We don't have commercial rent yet, but we're answering the question yes anyway. Is VAT chargeable on revenue during construction? No, there might be some residential rent happening. VAT reclaimable on residential operating costs? No, we're not going to be able to reclaim once we've done the development, because our VAT claim is related to the zero rating of the grant. It's not related to our operations as a residential rental landlord. VAT reclaimable on commercial operating costs. Well, that's if we were earning. So I'm going to put in a yes there. I don't think it's going to change anything in the numbers, because we're not going to put in any income for numbers. So depreciation on infrastructure over 50 years, that's 2% per year. Infrastructure allowance for year one on the tax wear and tear, 10%. And then after that, we write off over 50 years. So there's a reduced rate write-off. So your tax write-off and your depreciation write-off are different. For me, I'm not bothered about that, because it's just part of the operating, your depreciation is just part of the operating costs. I'm not splitting hairs about what is what. And we generally wouldn't be doing a tax calculation if we were a social housing institution. And this only makes a very small difference to a project feasibility. Working capital, the assumptions here, I never play with these if I'm doing this. I don't just leave these as they are. 14 days delay for revenue and creditors, 30 days for the VAT and the VAT debtor creditor. You know, you get it back next month. So you can change these, but I prefer not to change them. I just leave them as they are. Discount on prime and deposit balances. So spare cash you've got, you're earning prime -1. And if you're going to overdraft, you're paying at prime +1. then that just runs through the rest of the calculations. All these things will end up in the calculations, like in places like the financing and all of that. So we leave that to itself. We have already been through the table for entering rentals. So that's that is here. I'm keeping this dead simple. I'm just entering them as type 2 two bedrooms, but we could we could have a variety of these. For the purposes of the case study, we're keeping it simple. So it's 35 square meters. There are 7 of type 1 of income band 1. There's 33 of income band 2, and we're following these percentages here for the income spread to get to the 100. This project is 132 units, so we've done a bit of a calculation here to just get the number of units to the right percentage of the total. So this calculation here, 29.5%, that is our average rent quote over the whole lot. So I can't get to the left. Yes, I can get there. So that's our weighted average rent quote. Forecast residential vacancy rate. So there was 2% in this. That's fine. You can, we're not forecasting a high vacancy in this project. You can enter 2%. You can enter. You can vary that if you want. I'm just leaving it at the default that it started at. Commercial rent, if we were earning any commercial rent, we would enter those in years. So we might have 1 unit, there might be a shop, it might be a 50 square meter shop, and we might be earning 1,000 rand per month from the shop. Right. Shared ablution facilities do not qualify as social housing units. So if you've got something with rooms and communal facilities, you would enter them in the year. They would come in as other income. So let's say we've got 2 of these, and they're at 18 square meters, and we're earning 500 in rent from them. And our vacancy rate for commercial, we'll just leave it at the default of 3%. Any other income? Right, we're going to have some parking. So we've got some units for parking. Well, right, if we're saying we've got a 70, if we're saying we've got 132 units, but we've got 1 parking place for every 2 units. So it would be 132 times 0.5. Well, the floor area doesn't matter. How much is a parking space? 20 square meters? I don't know. I'm not even going to guess. Revenue per parking space, can we charge 150 a month? We'll put in 150 anyway. So there we've got a bit of extra revenue. Never let these extra things go that you can, that you can earn extra income from, because they all add to the viability. I've done the general inputs for operating costs on a bit of a lazy person's way. I've taken 1,600 as the total cost that I should be having. So if you look in the formula bar here, 1,600 times 132 units times 12 months, because this is an annual figure we enter here. And then I'm deducting whatever has been entered above. So this is like a balancing number here. this number here. So this is operating costs balancing figure. Right, our provision for bad debts, remember that gets entered here. The default entered in the model was 3.5%. I'm not going to play with that. So leaving that as it is. So that'll come to 194,000 for the year in terms of bad debt provision. Remember the maintenance, we had to have a provision of 1.02% for maintenance. Now the figure for the maintenance thing will look at all of these sections here for maintenance, and we'll add them together and see that they are 1.02%. I've been lazy and I've just said 1.02% times the total capex inputs and put that in as maintenance. So that would come in this case to 500 Rand a month, which isn't unreasonable, probably possible in a month of high maintenance. And so the rest of the operating cost balancing figures are come to 1,600. I've just covered the overheads under that as well. If we wanted to be pedantic between splitting overheads and operating costs, we could do that, yeah, by saying right. So we would. What did we say before? It was 904.50 got us to that. So what I'm going to do is I'm going to add the sum place here. I'm going to add the overheads, and I'm going to just put in a figure for overheads. And I'm going to say just overhead. And I'm going to say if we're going to be spending equals 300 times 132 times 12. So we'll find that our figure up here would now reduce a bit because we've chopped off a little bit, but the total operating costs and overheads would now be 1,600. If we're wanting to forecast utility costs in detail, we've got that facility here. Obviously includes gas. Joburg City focused. Gas is a difficult one. So then we've got our grants. Yeah, we've got our provincial grant that gets entered by the SHRA. The restructuring capital grant would have been entered elsewhere. I'm not sure where because the SHRA entered that anyway. So that's all done. Ratio of commercial operating costs to total operating costs. We said we had a shop. Let's make it 5% if that's going to make it. If that's going to make any difference, that'll probably affect that VAT calculation. So, but it's minimal in this case. Before we go further, does anyone have any questions about this input sheet? You want to raise your hand? There's caretakers, can you? Can I just deal with the questions at this stage? There's some new ones in the chat. Susan, can we use the lease land that is restructured by the SHRA? Well, if you've got a land availability agreement, I think 30 years is the term they like to have. So that's covered. Oh, John's already answered that, so that's good. Susan, can we have contact details for individual assistance on different projects? I think you need to ask the SHRA for those contact details. I'm sure they've got contact details for people who can assist, whether it's somebody inside SHRA or outside SHRA who knows this work. That would, I think, leave that to the SHRA to give you some help there. Tabile, a question I posed before we took the lunch break is where in the quick scan see we're going to the costs related to things like solar and Wi-Fi. I'm not sure why the question wouldn't show on your side. Okay, yeah, well, we've got the question now. Solar and Wi-Fi are part of your development costs. You could add a line item for them, and if it's not there already, you could put it in the other section. So you could show those. As far as I know, the subsidy is not going to add extra pieces for things like this. They're saying you've got to go and be green and make do with the subsidy, which in view of the massive increase in the subsidy is probably a pragmatic and reasonable way of doing it. But if you can get other funding from other agencies funding green projects, go for it. It all means that you've got less you have to borrow. So I hope that helps there, Tabile. Rabone, I couldn't get my questions through yesterday. What's that? Okay. If you'd like to ask those questions today, if they still haven't been answered, would you be able to either ask them by putting your hand up and telling us, or adding another one to the chat? Sorry, you might have to redo some of them. Andre, thank you for giving me the parking dimensions. Okay, there we are, 5.5 by 2.5, 13.75 square meters. Thank you for that. So for the sake of completeness and to recognize Andre's effort there, is parking was 13.75. Thank you for that. Okay, so there we have, now we have a completely populated general input sheet. I'm holding my breath. I'm not going to go to the results yet. Let's do the CapEx. That's the CapEx. Remember, it's only the two green sheets where we can do our inputs. So in terms of this project that we just used as the arbitrary case study, there was a cost of land of 6.6 million in there. And I don't think that would be 20% of our, if we bring the land into the project. So we might hit a snag. We might have to do something, but let's move on. In our building costs, I'm just using the one we used in the quick scan A yesterday. So the preliminaries were 2 million. I've just spread those over the 18 months. So basically just said the 2 million divided by 18 and spread that across the term. Your QS might give you a forecast with your S curve. You could just copy and paste that into here. This yellow area is yours to do with what you want to. So if you've got the QS estimate with an S curve, all the better. I've just simply divided them by the period we're going to be using them. So I've just said preliminaries we're doing equally over the term. The construction costs, we just had one figure of 45 million for construction work in our case study. So I just said 45 million over 12 months. Remember, we're doing this over 18 months from the start, but let's assume we're only ready to start construction in month 7. Some other things here, we've got some bulk services. In their case, they had to put in some money to bulk services, so I've put that contribution in right at the start, just after paying for the property. NHBRC enrollment levy, I know they wanted to take those in 2 chunks, so I've just put them in at 2 chunks during the process, one in the middle, one at the end. Right. Forget about these numbers here. This is me playing around trying to make our case study flexible. I'm using those in the calculations. Bond raising fee, put that in here. We might not need the bond raising fee because we've got all those extra charges added onto our funding there, but I've just left this intact as it was presented to me. So that stays in there. We've got general, lovely category called general costs. And that was in here for this. So I've obviously not divided by 18 because I'm not getting the full amount there. I've used the 18, so I've got to take general costs in for the full 18-month period. There we get back to my total I'm looking for. And then this other, the bottom, other one, I was, that was in the balancing, that was a balancing number to get to the figure I wanted to get to for the total cost. Let's look at the rest of it. We had some architect. I've put in all the professional fees just on the architectural line, and just spread them evenly over the term, over 18 months of the construction term. We haven't assumed any revenue during construction, but let's just put in that. Remember, we had a shop. Let's say the shop's going to be, that shop's going to be selling to the construction workers when they finish the job. So we'll put in a little bit of, we're just saying we're going to get some commercial rental. That R1,000 will come in a month, will come in during the operating period from where we entered. But if we assume that the shop's operating during the construction period, we'll bring that revenue in there. Any other costs happening during construction? Well, as far as the company is concerned, we've got to keep the company going, you know. So let's say we've got 500 management and administration charge through the term. Right, and so there's no actual commercial development happening here, so we're not going to fill in the bottom one. So that is a quick way of populating this. If you wanted to use your QuickScan C as an easy feasy, I know that the last round of training we did, we put into circulation an easy feasy model, which is basically a cigarette, I used to call them a cigarette box calculation, but you can do a quick calculation in the QuickScan C as well. If you just use things on a high level, you can use it for the same purpose. So those are our inputs. Let's have a look at what our summary looks like. Right, I don't see too too much red. I see only green ticks, except for our project IRR. Okay. We're not at 11 points. Where do we need to be? 15.25. Yeah. So we're at 14.21. So some tinkering is needed. Our debt service cover ratio is very good. That's at 1.68. We have got adequate maintenance. Remember, I took a shortcut to getting our maintenance up to the required 1.02%. Our monthly residential operating costs is within that desired area, so it must be above 1,300. Above 1,300, preferably 1,600 or below, and we fit into that very nicely. Our primary target market, we meet the 30% requirement, so that's all good. We've got nothing red here. At one stage, while setting up the case study, I was getting red on the long-term bank debt. See, we need to borrow 9.9 million in this case. And we have a facility of 15 million. There's our restructuring capital grant and our provincial contribution. So together they make up 426,308. Is there a per unit indicator here on the summary? Let's have a look. That subsidy per unit is just the restructuring capital grant. It's not the provincial subsidy. Maybe that should be changed to show the CCG, the combined grant. So we've got one indicator that's not working for us. So let's remember, we said how are we going to make those indicators work. If we recall, I'll just bring up the presentation again. No, it's not that one. Where was it? Where we said how we're going to get to, how we're going to fix. I think it was a bit further back. Yeah, well, these are the relationships that we've got to establish. So it's our IRR that's a problem. So what goes into the IRR? It's the it's the development cost. It's the rental income, operating costs, overheads. So we're going between the development costs and the rental income, operating costs, and overheads. We are going to have to find a way to improve our IRR. So let's go back here with that in mind. Okay. So let's go and look through what we can change. I don't think we can do anything about the rentals. Those are set at the midpoint of that range. So I think, the rentals are almost because this is the market we're dealing with, and that's what they can afford to pay. So I think I don't think we're going to make any changes to that. We could charge our shopkeeper a bit more, but we might not have a shop. So, and it's not going to make any difference to the overall, in the overall scheme of things. we're not going to be able to do anything about the share dilution properties. Can we charge more for parking? Maybe we can. Let's try 200 for parking. So there we've increased that. Our provision for bad debts is already quite slim. I wouldn't feel comfortable going to a lower number for provision for bad debts. Our maintenance, we can't go any lower than the 1.02 that was set. For our balancing figure here for the projects, we could, let's try and trim out overall cost here. Let's try and make it 1550. So let's trim our operating costs by that amount. And our overheads are already quite low at that, and it won't make a difference if, with the way I've done it, whether we change this figure or the operating cost figure. We can't do anything about the subsidy. This is, I'm just going to, in case that's affecting anything, I'm just going to take that, put that back to 0. I don't think it's going to have any major effect. So let's see, we're already on a thin budget. It's improved. Reducing our operating costs by 50 per month has added 0.4% onto our IRR. We've still got another 0.54 that we need. So we've gone through our layering process. We've reduced what's within our power to reduce, which is operating costs. Let's go to the last resort, and go to our development costs. So what I've got here is I've got a factor that's running through the model, which is this one here, which runs through the model. So we're going to reduce that factor and call it 0.9. It's that affects this row here, this other specifier, there's 12 million in here. So you see the 12 million's gone down to 10 million. So we've reduced what we've done by that is reducing our construction costs. Let's go to the summary. We're at 15.52. That's above. That is above the 11.75 plus 4.5. Oh no, it needs to get to 16.25%. 16.25%. So we need to reduce that factor by a bit more. It needs to go to 16.25%. Right, there we go. We've got we're at 16.4%. So using our last resort of reducing our development costs, we've managed to come in to meet all the criteria. We haven't met the 20% there though. So that's got to increase a bit. So that's 15.16. I'm going to go for, didn't realize that the way the formula was structured, it doesn't make that happen. So I'm going to change that said 20% of total construction costs. I'm going to change that to 16 million. Yeah, now we get just past 20%. So that's okay. And that should improve our ratios also. Yes, we improved there. We've still got green ticks everywhere. Now you'll see that our debt service cover ratio is very healthy at 2.48%. That is because it's an ODA and we've contributed 20% in cash equity. In this particular example, remember we spoke yesterday about maybe having land as your equity. Well, in this case, the land price was only 6.6 million. So we would have had to bring in extra equity ourselves. The shareholders of the company would have had to produce more equity. So it was that 6 million plus another nearly 10 million to get to 16 million to meet the 20% requirement. You see our loan, our bank loan is reduced to a level where we can manage it. It would be nice to see costs per unit here, but I'm sure they are in the assessment tool that the SHRA uses to do their assessment. It would be nice to just see things on a per unit basis also, because that's where we've got our, we have a feel for where things are in terms of our costs per unit. Right, that was to do with an ODA. I'm going to just save this as ODA. And then I'm going to do one as if we're a social housing institution. Same, we'll start off with exactly the same costs, but we're going to take away this 20% equity. Are we saying, yeah, is the applicant an existing SHI? Well, we're not an existing SHI, we're a new SHI. Yeah, so we don't have to answer that question differently. The only difference is between the ODA and SHI is going to be the equity. So I'm just going to multiply that by 0. It's easy to bring back again if we want. So now there's no equity contribution. All the other information is exactly the same. Let's have a look at what the summary says. Okay, so the summary says we've exceeded our facility. Easy enough. We go and change the input on the facility and make that 25 million. Right, so we don't have a red there anymore. We're now going to be borrowing 24 million in the project, which is 30, that's 30% of the total. That doesn't mean much. That breakdown doesn't mean much. We don't even measure it because the important factor on the amount of debt you've taken is whether you can repay it. And that's the debt service cover ratio. We'll get there. Let's go down the table. We're meeting our primary target market as we always were. Our operating costs are the same. Our maintenance costs are the same. Our project IRR is fantastic. Beats the target. But we can't repay our debt. So that is the problem. That's going to make us fail the quick scan A. Now we've already been through all of those other things we can change. Remember, if we go back to the Excel, if we go back to the PowerPoint presentation, all these things that we're now not looking at the IRR. So when we were at ODA, it was the IRR that was in trouble. Now we're a social housing institution. It's the debt service cover that's in trouble. So we've already been down the chain to see what we can do about reducing our operating overheads, given that our rentals are fixed in that zone. So then we've got to start going up the left-hand chain. So we need to reduce our loan repayments, which can be reduced by, can we get a lower interest rate from our lender? Let's try, we can try that. But we're probably not going to get very far in the current environment. The amount of the loan funding is probably that determines that, we're borrowing too much, in other words, to be able to repay. What affects our amount we borrow? That's our net development cost. Our net development cost, one component of that is the subsidy that's deducted from the gross development cost. And that's the only place we can still go. So we're going to have to tweak our gross development cost. We can't build houses that are costing how much? At the moment, these houses are costing us 613,000 per unit. That's clearly way too much. Remember our metric of subsidy plus 100,000. So we need to get that cost reduced. So I'm going to try and get that cost to 426 plus 100 to 526. So let's just do trial and error here. No, still too much. You can ignore this factor I'm doing. I'm just using that to get to a quick answer. So I could do a goal seek, I could do this, but it's been disabled. No, I can do a goal seek. So I want to set that cell there is our figure we'd like to build for. So I'd like to build for 526 308. Now you need to set that cell to value. Well, let's just be simple and call it 530,000, okay? And this is the cell there that we need to make 530 by changing this factor cell here. There we go, it's done. So we are going back to the summary. And we have a green tick. We're at 1.35 on it. So we've beaten the 1.3 debt service cover target by reducing our development costs. Our development costs are now 530,000 when they were previously over 600,000 as an ODA. That tells, and now that highlights what benefit an ODA would have, because with that, you're using that 20% extra equity to be able to build more, put more into the units, can make them more expensive, and you'll have a better product. Whether it's a wise idea or not, when your rentals are the same, well, that's for you to make your financial decision. But clearly, it gives the ODAs an advantage in terms of the tight metrics that get applied here. Yeah, so I see we're not meeting that metric any longer because our costs have changed. And we need to get the maintenance to 1.02 of of the maintenance costs again. So overhead forecast, here's the maintenance. Maybe we'll just need to make it 1.03 to get that above the line. Yeah, and it does. It was probably a decimal point that was pushing it below. And so we're below the maintenance target. So we've got all of those measures in place. Now that would be if we are a VAT register, if we've got this little group that's a social housing institution with a VAT registered developer. So if we answered no to this one, I wonder what the answer, what it would be. I'm just going to save this file as it is. This is ODA. This is SHI. SHI VAT vendor. Now we're going to have SHI non-VAT vendor. That's going to go to no. That was still green. Everything is no. This doesn't look right. That should change. Because that VAT vendor should set off a chain of calculations. But the calculations I did yesterday outside of the quick scan C model showed that we would have a clear difference if we're in SHI between a development cost. It makes a difference of about 60,000 in development cost. When we're able to reclaim our VAT. So the basic principle here is still that we can build for 526 less 100,000 loan amount per unit, and we'd get to we'd end up with a viable product. With the VAT registration, I worked out that we should be able to build for 587,000. So there's more that we can put into the building so that the net cost then reduces to the 526. So as long as your net building cost is at subsidy plus 100,000, there you should be okay. So this is what is being shown here, because the VAT calculations have been turned off. It's when we had the SHI VAT vendor that should have shown better results than are being shown. But that will be fixed up before I'm sure that will be fixed up before the next version of the quick scan C gets distributed. Unless there's another place where I've got to go and make a change. But I did think that, yeah, why it's not making a change. Here it is, because we said no. We said no, nothing's reclaimable. Right, silly me, apologies for that. There are two places where we have to go and make a change. And we're not going to have any VAT there. Right. So now we are not a VAT vendor. Same metrics there, but we don't meet our debt service cover. Yeah, so we don't meet the debt service cover, and we've then got to go and tweak this figure downwards again. So I'm going to do a goal seek to get that. What if goal seek to get that number there to 530,000 by changing that cell. Okay, so let's have a look. Borrowing 13 million. There are 132 projects in this scheme, so the 13.2 million divided by 132 gets you to 100,000 per unit. And let's look at our ratio here now. We're meeting our target, so we're meeting our debt service target. We're making an unbelievable IRR, 30%. Okay, but that's our most important indicator is to keep ourselves afloat when the time comes to repay the loan. Okay, so that is largely done for illustrative purposes. I can't guarantee that this particular set of figures we used are indicative of any particular SHI. It's not based on any one SHI, so it was just a set of figures that made the thing work. And with that, I'm going to save this. So we've got 3 saved versions of the case study that not very good. Remember that your VAT vendor, if you're an SHI, your VAT vendor has to be the development company. You couldn't be able to register your own SHI as a VAT vendor. You would have to have a second company in the group. And there'd have to be a good reason. They'll challenge you to see why are you setting up this extra company in the group. So you're going to have a very good reason that it's not for VAT planning purposes. Fortunately, those who have those in place already had very good reasons, historical reasons for why there was a development company in the group. But that will be a challenge between you and the receiver of revenue when you are making that application. Any questions? Okay, Velile, I see we have 8 minutes before the end. Velile, that's yes, can sometimes make it shorter, but it gets tight. Okay, yeah. So it's a discussion about the parking. Yeah. Okay. But yeah, we have got parking is a side issue. So this was Rabone, couldn't get your questions through. Your subsidy ends at development cost and doesn't go as far as rental defaults. That'll be the owner's baby to carry. Yes, indeed, that is the case. Rental defaults are the responsibility of the SHI, whose responsibility it is to get the right kind of tenants into the property you're going to pay. Try not to get people in who are going to organize rent boycotts, all of that kind of stuff. So be careful about who you choose as your tenants. There's no There's no bailout for that. There are some municipal SHIs who have been bailed out by the municipalities, but that's not best practice. If there's someone in the meeting who's in the business already, can I share why this social housing is better than participating in normal property leasing? Okay, we'll leave that open to the forum when you can raise hands if you want to. Velile, what's the entire property? Is this, Velile, I'm not sure what you were asking there. 0.5 to 0.7. What is that the default rate, or is that the, oh, you mean the ratio? Yes, the parking ratio, normally between 0.5 and 0.7. Yeah. So you'll have 50% or 70% of the number of units, you'll have that many parking spaces. All depends on where you are. You have different ratios for different areas. Okay. Can be anywhere 25 to 30. Yeah, less space in the inner city. That's Sanela's email address and Chilombo's email address. Thank you. Andre. Okay. I think that answer has been questioned. You know, figure out and finish your project with a 20% equity shareholder. Oh no, good. Good. Okay. So anyone wanting to get a 20% equity shareholder, call this number. Save it, write it down. Save your screen. Where's that number? There's some advertising. Yeah. There's the phone number again, struggling network. So we're at the bottom of the questions in the chat. Anyone have any questions? Want to raise your hands? Okay, John, I think that concludes it then. Thank you very much for your attention. And remember, the route to the viability is to make sure that your debt service cover is covered from your operating results. So you've got to be keeping your rent inflow higher than your loan repayments.
Okay, thank you so much, Larry. This, ladies and gents, I think brings us to the end of the 2 days. I know I'm also sitting here thinking, sure, it feels like there's a lot to digest, right? But guess what? I mean, I think that as you work these things in the manner that we've tried to demonstrate to you in the last 2 days, it then lessens the stress of you managing or having to deal with a project that is problematic and gives you more gray hairs. I do want to say, as what we indicated yesterday, that you have an opportunity to make contact on a case-by-case basis and discuss specifics and get help with the specific process owners within the SHRA. And I've put up on the chat line the contact details of both my colleagues, Sanele Maluleke and Shilombe Mageza, who are both can be contacted on those email addresses, sanelem@shra.org.za, or Shilombe, which is spelled XILOMBEM, @shra.org.za. I would encourage that let it not end here. make contact with these colleagues who really are available to meet with you and assist you with regard to the specifics around your project application. We also have, another chance to give it another step. In a few weeks' time, we will again be presenting this, I guess, to a different group. But if you feel you want to cement your understanding around some of these things that have been shared so speedily in the last 2 days, absolutely do let us know. We will include you in our confirmations of the next session in November. Please allow us a few more days, because as you picked up, there are a few gremlins, and Larry will be working to just bring some of the latest data into the model. So do allow us a bit of time with regard to making those necessary updates, but we commit that within the course of next week, you should receive from us in one mail shot all the material handouts, the tools themselves, and the link to the recordings of these last 2 days. Other than that, I'm available on my email address, which you should all have on the email that I sent when we shared the confirmation of the session, john.m@shra.org.za, if there is anything else. Many of you may have also been enrolled or registered for other sessions, such as Introduction to Social Housing and so forth, and we're working behind the scenes in trying to make sure that those can also be delivered as per schedule. I know some we've had to revise the schedules for several times. But on that score, it is 1 o'clock. Let me just thank you all for coming through, and hope this has at least shed some light in terms of how you may approach this exercise specific to packaging potential social housing project. Thank you. Hopefully this is not the last we speak. All the best and enjoy the rest of the week, the weekend. Thank you. Bye.
Thank
Thank
you.
you. Bye.
Thanks. Bye-bye.
Bye.
Thanks, John.
Bye.